This stock review focuses on INVENTURE Growth and Securities Limited, NSE, INVENTURE. We issue a severe warning. This stock carries extreme governance and regulatory risks. The price is around 1 rupee and 20 paise to 1 rupee and 25 paise, trading near its 52-week low. The trend is bearish, having dropped about 47% in the last year, placing it at an extreme danger risk level. In the executive summary, we reiterate the severe governance and regulatory risks. The company is plagued by internal fraud, SEBI penalties, and declining operations. It is undergoing a complex restructuring or demerger, adding uncertainty. This is a speculative instrument that has eroded significant shareholder wealth, not a value investment. Crucial governance and regulatory red flags include internal fraud in May 2024, where an employee admitted to transferring 1.46 crore rupees in securities from client accounts. SEBI took recovery actions in November 2024 related to unpaid penalties for trading violations. Furthermore, the company was banned by SEBI for 4 years, starting 2018-19, due to IPO irregularities. Our Q2 FY 2025-26 analysis shows a shrinking business. Revenue was 13.41 crore rupees, down about 15% year over year. Net profit was 0.80 crore rupees, which is technically profitable compared to a loss last year, but negligible for a listed company. Core operating margins are weak, and the company struggles to generate consistent cash flow from its primary broking business. The company is undergoing a, quote, scheme of arrangement to reorganize its business. This restructuring involves amalgamating subsidiaries and demerging its lending business. New SEBI rules restrict stockbrokers from running other businesses like NBFCs within the same entity. The risk for investors is value locking, where you may end up with illiquid shares. Regarding valuation, the price-to-book ratio is approximately 0.46x. Although the stock trades at half its book value, this is a trap due to internal fraud and governance issues. The market does not trust the book value. Promoter holding is dangerously low at 26.40%. If promoters believed in a turnaround, they would likely increase their stake, which they have not done. The technical outlook shows a lower low formation trend. The stock recently hit a fresh 52-week low of about 1 rupee and 17 paise. Resistance is at 1 rupee and 50 paise. There is massive supply from sellers at every uptick, indicating significant selling pressure. Our final verdict for investors is to avoid this stock. The combination of employee fraud, SEBI penalties, and shrinking revenue makes it structurally unsafe. For traders, the risk is high. Do not be tempted by the low price. The stock is illiquid and prone to getting stuck in narrow ranges. If you found this video helpful, please kindly like and subscribe.